This is the UK economy since the 1950s. You can see the trend rate of GDP per capita has fallen from 3% to less than 1% a year. But the tax share of GDP has risen from 29% towards 38%. The British economy is now on shaky ground. Productivity has flatlined, growth is stalling, and the government's fiscal plans may be about to unravel. For decades, Britain's productivity grew at around 2% a year, and this enabled higher wages, higher living standards, and more money for public services. But since the financial crisis, productivity has barely grown. This is where the economy could have been if the post-war trend growth had been maintained. Now, after a flash estimate for August showed productivity falling by 0.8%, there is growing speculation that the OBR will have to downgrade its productivity growth in the upcoming budget. Now, why does this matter? Well, if there's just a 0.3 percentage point downgrade, that leaves the Chancellor with a 26 billion black hole. If there is a 0.5% downgrade, that's a 44 billion black hole. That's a lot of tax, and to put it into context, George Osborne's austerity budget of 2010 involved a 40 billion contraction. And productivity isn't the only problem. The broader economy is showing signs of weakness. Growth in the past 3 months has dropped back closer towards zero, but the labour market is also softening. Unemployment is edging up, and PAYE data shows fewer people in work. Recent tax rises like higher national insurance are adding to business costs and discouraging hiring. It means that the UK economy is showing signs of being an outlier in terms of both inflation, well above the OECD average, but also now in terms of a labour market. It's a bit of an unwelcome headache for a Chancellor at a time when confidence is relatively low and taxes as a share of GDP are already rising towards record levels. Now, there is good reason for considering a productivity downgrade. Firstly, past OBR forecasts have been consistently downgraded themselves. It would require quite an optimistic take to feel this is the moment when the economy is finally showing signs of a big turnaround. Now, some optimists may argue that a lot of the bad news is already baked in. The ONS actually expected a weak start to the year in terms of productivity. The dismal figures are actually in line with expectations. Also, the Bank of England, usually much more pessimistic than even the OBR, have slightly increased their expectations for the economy. In their August report, they mentioned potential productivity growth has been somewhat less weak. So I think that somewhat less weak is what counts as good news for the UK economy these days. But also, if you are a glass half full kind of economist, you could argue that the past poor productivity was at least partly attributed to crises like austerity, Brexit, COVID, and then the gas shock. Without this kind of shock, plus slightly higher government investing and falling labour market inactivity, it could start to modestly improve. And also maybe you get help from the private sector. Maybe firms will find a way to use AI in a way that would actually increase its productivity. But I think that until you see more evidence in the actual data, this remains a rather hopeful rather than realistic take. And if the OBR were to cut its forecast to match the consensus amongst economists, it would deliver a 20 billion blow to the Chancellor's financial headroom. That means effectively really 20 billion of tax rises to come, and enough to create more bad headlines and perhaps hold back growth even more. Now, ultimately, trying to predict productivity growth over the next 4 years is very difficult. It's a real judgment call, and the OBR will probably be conscious of the political costs of a downgrade and also the costs of the economy, given the government's fiscal targets. And you could argue it's really quite unsatisfactory that so much relies on essentially a judgment call about predicting something highly uncertain over the next 5 years. But that's where we are. And another kind of headache really is that with inflation being more stubborn than some expected, the government will feel there's relatively limited room for manoeuvre with regard to borrowing. Already this year is a record for gilt sales, with rising bond yields around the world dismal long-term fiscal forecasts. It all makes it much harder to borrow than, say, the last decade, especially with the Bank of England selling the gilts it bought during quantitative easing. Now, economic growth in the first half of 2025 was 1.1%, which is in a way quite respectable. But with the threat of more tax rises coming, a global trade war, falling real wage growth, there's likely to be weaker demand in the second half of the year. Now, of course, you may well ask, isn't there a way to get out of this spiral of stagnation and doom and gloom? Of course, the real prize will be to find a way to boost productivity growth. That would be the real secret to making everything much easier. The government will hope that planning reform could play a role. If it's easier to build, construction can play a role in boosting economic growth, and in theory start to moderate the immense cost of housing, which does so much to hold back living standards. However, the planning reforms have been somewhat watered down, and construction is struggling to get going, along with all the other factors such as building regulations, weak demand, high stamp duty, slowing down the housing market. The government have announced a new industrial policy at a time when the biggest downward factor in growth last month was industrial production. It continues this worrying trend to deindustrialisation, with the manufacturing sector having shrunk from 16% of GDP in 1990 to just 8% today. A big cost, of course, has been high electricity prices, but the government haven't found a way to implement the kind of reforms which actually reduce prices, like regional pricing and maybe lower tax on electricity. Now, the INEOS boss has made noises about pulling all investment from the UK on the basis of the UK's unstable fiscal regime. But to be fair, the UK is hardly an outlier in this sense. You could argue we're not as bad as France, for example. Maybe there's more going on about his frustration, perhaps, with his investment in Manchester United. Anyway, the other big decline was in pharmaceuticals, a sector traditionally strong in the UK. There's quite a bit of disquiet amongst US pharmaceutical companies about the NHS drug pricing regime, which is able to get significantly lower prices for customers than in the American healthcare industry, where, of course, prices are really extortionate. But it is worrying that big pharma firms have held back from investment in the UK, because this is something the economy does need. And the problem is that attracting this American big pharma investment may well involve a trade-off in much higher drugs prices, which of course be a real problem for the NHS. The other issue is that with taxes going up, what is the best way to tax? Certainly taxing national insurance contributions is one of the more growth-unfriendly options, directly hurting employment. Alternatives will be a windfall tax on banks, reforming capital gains tax, taxing property directly rather than through stamp duty, which increases the cost of moving. Now, another issue, inflation has definitely become another headache. And again, forecasts of falling inflation have been pushed back. Now, whilst it is true that to some extent, higher inflation reflects one-off rise in utility bills, the higher inflation itself is starting to push up inflation expectations. And this can make inflation harder and more costly to bring down. After a brief period of real wage growth in recent months, inflation of 3.8%, of course, is eating into that real wage growth, meaning that workers are once again squeezed, and of course they'll have to cut back on their spending, and this will have an effect on reducing investment. Now, the boss of Barclays argued that the government need to limit the pay rise of public sector workers to bring inflation down. It's pretty easy to call for pay restraint when your own pay has doubled to 10.5 million a year. But from a perspective of public sector workers, they've had a decade of falling behind the private sector, and they feel they have a need to catch up. RMT workers recently went on strike on the London Underground after rejecting a 3.4% pay rise, so that's always going to be difficult to restrain public sector pay. Now, there is some good news on the economy. Rates of economic inactivity are coming down, still higher than pre-COVID age, and there's the usual uncertainty about the reliability of data. But high rates of inactivity have been a major constraint on the economy and also the government's budget. But despite this, there's still a major rise in health-related benefits to come, and finding a way to limit the growth of health-related benefits, finding a way to get people back to work, is still a big objective for the labour market, which has a big economic benefit. But it requires a reform based on evidence rather than just meeting short-term fiscal targets, which is why the welfare bill failed this year. Also, although there are fears of tax rises this autumn, In a way, you could argue British consumers are ready for it by preemptively increasing their savings, which are quite high by British standards. Therefore, actual tax rises may not be quite as damaging as some fear. Now, a big theme for the economy is the price of energy. And it is a concern that despite oil and gas prices falling really very significantly this year, it hasn't really translated into lower energy prices for households and business. This video looks at a really complex reason why energy prices are so high and what we could do about it. And that would really help the economy. Anyway, thanks for watching. Do subscribe, like, share, all that kind of stuff. It does help. Anyway, see you soon.